Hi everybody, welcome to our DAT IQ weekly market update. This is our update for August 24, 2021. I'm Dean Croak, market analyst here at DAT Freight and Analytics. Today I'm sitting in for Ken Adamo, and as always I'll be joined a little bit later by Ned Adamo. Sorry, can we start again? No. I was sitting in for Ken Adamo, and as always I'm joined by Ned Damon. Sorry, Ned. And a little bit later in the show we've got a special guest today, Associate Professor Jason Miller from the Broad College of Business at Michigan State University. For those new to the program, we're here every Tuesday at 10 a.m. Eastern, 7 a.m. Pacific. We talk about trends in the freight market and what to look out for. Most importantly, though, we're here to answer your questions, which you can put in the chat section below. But as you will have seen and heard, or not heard, as it turns out last week, we're a company that's a software company primarily serving the trucking industry. We're not a media company, and as a result, our last week's show had some technical difficulties. Thanks to all our viewers for bearing with us as we build out our new Denver studio. Okay, so let's get into the show. Remember, drop your questions in the chat section. We'll get to them towards the end of the program. Things tend to pile up towards the end of the show as we get sort of going. So if you want to get your questions in early, that'd be a great idea. Drop them in the chat section. We've got a crew working in the background to get them over to you as quickly as possible. If there's anything we miss or we don't get to your questions, remember there's a written version of the show in our weekly market update at dat.com/market update. And with that, I'll get over to the market update for the week. So some of the key trends we're watching this week, dry van and reefer spot rates were relatively flat, but flatbed rates were down for the 7th week in a row. Not a lot of direction in the dry van and reefer market. Contract rates are still rising, but what's significant is the increase is at a slower rate this time, still up 6% in the last 2 weeks compared to the 2 weeks prior, but the rate of increase is slowing down. In the flatbed sector, it's about the only sector that we see behaving as we'd expect seasonally, with rates trending down after July 4. Some data points out last week we're watching. Housing starts are down 7% month over month. Permits, which are a leading indicator of flatbed demand, are down 3% month over month for July. So some indicating signs there that we could see some slowing demand for flatbed in the building and construction industry. Of course, weather was the big story in the last few days, last week in particular. Northeast spot markets saw surging volumes and rates as the remnants of 2 hurricanes soaked the region. We've still got 81% of the hurricane season to go, and September is generally the peak. What we had, we've got 3 systems I noticed this morning on the Weather Channel building up in the Atlantic. In the trucking sector, I-95 was closed on Sunday in Connecticut due to high wind. Lots of flooding reports, lots of secondary roads closed, so a lot of delays for carriers in the Northeast this week. And of course, rain and torrential rain and flooding closed Interstate 40 on Saturday, resulting in 21 fatalities in Tennessee. Tragic story, number of people still missing. And the other trend we're watching, of course, this week for carriers and brokers in particular, this is Brake Safety Week. And I think combined with the tropical storms in the Northeast, we're going to see a lot of market volatility. Just a reminder for carriers and brokers, especially those carriers and brokers that are dispatching trailers that have been sitting in drop yards, those brake systems tend to have the least attention and will be the most vulnerable to being put out of service during this particular brake safety week this week. So send a message out to all your carriers and drivers, make sure they get on top of the brake systems and brake adjustments before they head out with a load. All right, so let's start the market update with our load board activity in dry van. After being flat for the last couple of weeks, dry van load post volumes took off last week. They jumped 7%. And of course, that's ahead of the much anticipated commencement of the school and college year, which has started and is starting next week for a lot of children and college students. Equipment post decreased by 3%. That had the combined effect of increasing the load to truck ratio in dry van to 6.38. And in our top 100 lanes for loads moved, volumes decreased on more lanes compared to the week prior, which is a trend that I'm watching very carefully. Volumes were neutral only on about 8 lanes. They were down on more than half of the lanes last week, down on 59 compared to 52 last week. Okay, moving over to the load board activity for the refrigerated sector. Shipping volumes increased by 4% last week after being flat the week prior. Equipment posts were up, resulting in the load to truck ratio increasing very slightly to 14.17. The change in load volumes was more pronounced across our top 70 lanes last week. Loads moved were up on 29 lanes. down on 37 lanes and neutral on 5. Again, all the data is in our weekly report if you want to get all the statistics behind what we've just covered. And in the flatbed sector, after decreasing for 3 weeks in a row, flatbed load post volumes reversed course last week and increased by 5%, but capacity continues to loosen. Following another 1% weekly increase in equipment posts that had the combined effect of pushing the load to truck ratio up to 41.66. So let's have a look at our market condition index for dry van. Of course, weather was the big story this week in the Midwest and Northeast regions. In Tennessee, we had the I-40 close, and the remnants of 2 hurricanes made their way through the Northeast within the space of a couple of days. Hurricane Fred and Henri caused major flooding. Of course, they made landfall as tropical storms, but it affected freight markets all the way from Pennsylvania right through to Massachusetts, including Rhode Island, Connecticut, and New York State. I-95 was closed, as we mentioned, but that wasn't before a lot of freight was moved out, especially in Long Island, New York. A lot of volume was moved out late last week. In Brooklyn and Hartford freight markets, which took the direct hit, outbound volumes jumped 44% last week after declining for the 3 weeks prior. So a lot of freight was moved out late last week out of those particular markets. And just north in Springfield, Massachusetts, it's a big manufacturing hub. That's also where FEMA staged all of their emergency relief freight ahead of Hurricane Henry. It was at the Westover Air Reserve Base in Springfield, just on the Mass Pike or I-90. Inbound volumes into Springfield last week increased 16% as a result of the staging of freight. They'd been declining for the 4 weeks prior, so some noticeable volume there in the spot market as a result of the FEMA staging. Capacity also tightened in Springfield last week. It's a small freight market, but there were lower volumes, but spot market rates jumped 12 cents a mile to an average of $2.62, excluding fuel. And in the refrigerated market condition index, again, the Northeast was pretty tight for capacity overall, very tight in the refrigerated sector. Inbound load volumes increased by 9% into the Northeast last week. Outbound volumes jumped 16% last week as carriers moved freight out for shippers and brokers. Outbound spot rates across the Northeast were up about 12 cents a mile to $3.27 last week, significant jump out of what's normally a backhaul market. Other noticeable trends in Brooklyn, which was forecast to take the full force of Henri, spot rates jumped 33 cents a mile to an average of $3.01, excluding fuel. Volumes were up 28% week over week in the Brooklyn market. Nearby Elizabeth, New Jersey, outbound volumes jumped 18% last week. And on the 870-mile run from Elizabeth, New Jersey to Atlanta, pretty busy lane for carrier. Spot rates jumped 24 cents a mile above the July average to an average of $2.65 last week. Wrapping up with a quick look in the Pacific Northwest in the Twin Falls market, the USDA reported a slight shortage of trucks last week to haul potatoes in particular. Spot rates increased 2 cents a mile to an average of $2.57 on 20% higher week over week volume. So it looks like there's some activity coming out of that particular part of the country as produce season swings into full gear. Just north in Pendleton, which is just north of Twin Falls, volumes were up 5% last week. Capacity was very tight though. Spot rates jumped 9 cents a mile out of Pendleton to an average of $2.54, and that's after increasing for the last 3 weeks also. So definitely some tight capacity in the Pacific Northwest. Wrapping up the market condition index look in flatbed. Staying in the Northwest, in the Pacific Northwest in particular, it's a lumber-rich region. A lot of our softwood plantations are located in that area around Seattle and Portland. Spot market volumes spiked last week by 44%. A lot of freight coming out of the flatbed. Spot rates jumped 46 cents a mile last week out of that particular region, averaging $3.08 per mile to all destinations. Some lanes were mixed though. Seattle to Stockton rates were down to $1.94. Portland to Stockton rates were up to $2.51. So a lot of variation. A lot of volume went to St. Cloud, Minnesota last week out of that region. Rates are up 10 cents a mile to an average of $1.78. And something going on in the Ontario market last week. Load post volumes on our load boards almost doubled last week in the Ontario market. Most of those loads were heading to Fresno. It was the most popular destination. Shippers and brokers had no trouble with capacity. Spot rates on that lane ended last week at $3.15 per mile, excluding fuel, and that's about 27 cents a mile above the July average. Okay, so wrapping up now with our dry van spot rates year-over-year view. As you can see on the chart there, rates are sort of staying relatively flat across the top in the red line, averaging $2.43 a mile for the third week in succession. They've been around that level, still 42 cents a mile higher than this time last year, and 62 cents a mile higher than the same period in 2018. On our top 100 lanes for loads moved, spot rates were neutral on just under half versus a third the week prior. Rates were up on 33 lanes and down on 26 lanes compared to 37 the week prior. And refrigerated spot rates decreased by just over a cent a mile last week to an average of 277, still 58 cents a mile higher than this time last year. And in flatbed, wrapping up with our year-over-year view of spot rates, flatbed spot rates have now decreased for the 7th week in a row. Following last week's 3 cent per mile drop. They'd been dropping about a penny per mile in the 6 weeks prior. Last week was a reasonably significant drop of 3 cents a mile to an average of 262. Spot rates remain 55 cents a mile higher than the same week last year and 38 cents a mile higher than the same time in 2018. So that's it for this week's market update. If you'd like to find out more about what's happening in freight, go to our weekly market update. You can find it under the resources tab at DAT.com, or simply type in DAT.com/market update and download the PDF version. So now's the time to have a look at the forecast, the short-term forecast for the week. Do we have Ned with us on the production side? Okay. Yeah, all right. So Ned's not with us this morning. We've got some technical difficulties in the Portland region. So I'll do the short-term forecast and then we'll get into our discussion with Professor Jason Miller. So as you can see on the spot rate there, there's a fair bit of model agreement. Short-term forecast is upward. The green line is our rate cast one. That's probably the forecast to watch more closely. We're expecting that spot rates will continue to increase through towards the end of September. I don't think that's any surprise. Contract rates are still rising. We expect spot rates to still rise. Capacity is still tight. Drivers are still in very short supply. So definitely an upward trend there on all of our 4 models. And in the refrigerated sector, a lot of model agreement. We're expecting that on the ratecast model, rates to trend upwards from where they are now at about 275 up around 285 a mile. So there's room for movement there on the ratecast model of about 10 cents a mile. Produce season's a long way from done. Of course, we see an uptick in volume towards the Labor Day weekend coming up, and then we get into a lot of the high volume produce and fresh meats around Thanksgiving. And in flatbed, wrapping up here, a lot of downward movement, a little bit of model agreement on some of the high and low forecasts. The ratecast model is our flagship model. That's the one to watch. It's expecting that rates will continue trending down to about the 260 a mile mark. That's excluding fuel before we start to see that typical upward trend that we see towards the end of the year. So that's it with the look at the forecast. I'd like to now bring in our guest, Professor Jason Miller, and talk about our DAT IQ question of the week, which is really about retail freight. I'll just quickly pull it up here. What we're looking at now is a question that we've been all trying to answer. I know Jason's talked about this a few times on his LinkedIn channel and on various shows. And the question is, given the shift in consumer spending from goods to services, what effect will that have on freight markets as we head into the rest of this year? Over to you, Jason, and welcome to the show. Great to have you with us.
Hey, thanks, Dean, for having me on. I really appreciate the opportunity.
Yeah.
So I think, starting sort of first with this question in general is the one thing we were talking about very much last year at this time had been, okay, retail freight is very much sustaining the market right now. You could see that in how the dry van spot market had popped so much because of the overload of freight on certain lanes. And you could start seeing dry van contract prices were going up. Those things are staying fairly flat, though, more on the flatbed side. But I think a lot of us, what we expected was once the consumer starts running out of money, we'll just start seeing a transition more towards industrial freight. And while we have seen that, the key challenge right now is manufacturing supply chains, be it automotive, be it furniture, wood products to some extent, are so snarled at the moment that as we start to see consumer spending shift more than anything down right now, and we're seeing that from the Bureau of Economic Analysis data on personal savings, That number and for June was 9.4%, which is by far the lowest level it has been since COVID. Long-term average pre-COVID, that number was about 8%. It peaked in the 30% period during the worst of the lockdowns. But we've seen personal savings rates are basically heading towards their long-term trend, and personal income's going down now that stimulus is being exhausted.
Right.
And so, I mean, the answer that I would have on as we start to see that shift away from goods is that is going to reduce overall demand. And my biggest concern right now is I don't know if the manufacturing side is in a position to really pick up some of the slack with that.
Right.
Sorry, go ahead.
Oh, it's a good question. On the manufacturing side, I've seen you write and talk about this a lot. And we've had some of those, online debates about how much volume the manufacturing sector actually contributes to truckload. Might be good for you just to sort of recap how much it is, because I think you said it was about 63% of ton miles or something thereabouts. And because manufacturing is the majority of the driver of demand for truckload. Is that a correct statement?
Yes, that is correct. So, and where this statistic comes from is every 5 years, the Census Bureau does this massive survey of shippers. It's called the Commodity Flow Survey, and it is the document that is collected that essentially forms the basis for all freight planning at a national level when it comes to infrastructure. And so they collect data on millions upon millions of shipments from a stratified random sample of shippers across every different industry for every different mode. So this is like the omnibus document. And Dean, per your point, it's about, I just checked, 58.6% of all ton mileage. It originates in manufacturing for hire truck transportation with that breakout. If we take a look back to the first commodity flow survey that we have that detailed breakout, back in 2007, that number was about 62%. Mm-hmm. And that may not seem like a lot, but that is a massive secular transition away from manufacturing as a driver of demand for truck transportation towards increasingly the trade sectors, I'd call it, which would be warehousing activity, wholesale, and retail.
Right. Yeah, that's an amazing statistic, because a lot of the news cycles have been focused on import trade, retail freight, fast moving consumer packaged goods at the port, and I keep thinking that's a headline that could be a little bit misleading, because then you look at some of the broader truckload demand indicators and they sort of suggest that overall tonnage and truckload volumes are somewhat relatively flat, maybe up slightly year over year, but certainly relatively flat.
No, exactly. And it's a great point. And the comment I would always make is from the commodity flow survey, we can ballpark that we know there's at least 200 million truckload shipments a year. And that's just truckload, at least 200 million shipments a year in the United States.
Yep. You
start looking at the total amount of imports. Journal of Commerce for 2020 had that number, 24.5 million 20-foot equivalent units. So when you start slamming that into truck trailers, you're down to 12 million. And then you have to factor in how much of this is the line hauls done by rail.
Right.
So you can very quickly identify this is a small percentage of the overall market, not to diminish the importance of the retail side. But when we really look at what supports those 4, 5, 10 power unit carriers operating throughout the United States, it's still heavily manufacturing activity.
Right. Yeah, great data. It's a fascinating discussion. So do you want to dive into your slides to sort of set up the discussion that we want to have a little bit later on?
Yeah, absolutely.
We'll get our production crew to.
And so this first slide, what we're focusing on, what I'm going to focus on here is, just as Dean mentioned, there's all these different indices for demand, and the ones that many of you are probably familiar with are the American Trucking Association's tonnage index and then the Cass shipments index. A colleague of mine and I, Yembo Imole, now at the University of Tennessee, we've derived our own sort of index for overall demand for truck transportation as well as demand for surface transportation from various government agencies. And as we sort of take a look, and I like to think about surface transportation, which is really truck and rail together, because you have that competition between truck and rail for the intermodal market. So just looking at truck sort of misses that aspect. Is if we take a look at really where we're at right now, is we're down essentially the last couple months on a seasonally adjusted basis. We've actually seen activity declining. We're still up on a year-over-year basis dramatically, over 7%. And that's granted because we were coming out of the COVID-induced recession still as of last June. But as we think about what's going on, is we're still down substantially, multiple percentage points from the peak high that we saw in Q2 2018. And so I think per Dean's comment, the one thing to sort of think about is, yes, spot rates are at record levels. We've seen contract rates at record levels, but that is very much a story of demand rebounded much more rapidly than supply. Not that we have record demand levels, to be very, very, very clear, which really affects how we think about what happens as we start seeing truck transportation employment keep going up over the coming months, as all of us expect to have happen, because that has a huge implication for, could we see a market turn just like we did in the second half of 2018 and 2019 if too much capacity gets added in if we don't have the demand to support that. Now, I mentioned rates a little bit, and so if we can move on and take a look at that, there's no other way to put it right now other than rates are at levels that are at essentially record levels. So the two ways that I sort of look at rates from my end, just looking at public data that I can access as an academic, is one is the Cass Truckload Line Haul Index, which is shown here in red, that behaves very well, and that comes from Cass processing billions of dollars of freight bills. And then the other, which is in black here, which is something that I'm calculating off of Bureau of Labor Statistics data, is a producer price index that takes data from general freight long distance truckload and then specialized long distance trucking, and combines that together based on each sector's revenue. And just to give some statistics for where we are at today in comparison to where we were last year, the combined Bureau of Labor Statistics data, year-over-year increase in price is 18.1%. This is from July of 2020. And relative to our prior maximum, which was seen in December of 2018, prices are 12.9% higher than what they were, which is an incredible increase. Now, the key thing, though, that you're seeing with both of these indices is they do appear to be starting to flatten out as of roughly May. And this makes sense given the dynamics that we've seen, and that contract prices have now risen enough that routing guides are starting to maintain better for shippers than they were. And so my expectation for the price that the carriers themselves are receiving for contract freight, which is primarily what these are capturing, is we're going to be probably fairly flat through the rest of the year. If not, if we start to see spot rates start to tick down a little bit, we'll start to see this inch down. But as we move forward, though, there is something being sort of masked by this aggregate if we talk about all of truckload rates. And as we'll see on the next slide, what is being missed is that we're seeing some different dynamics for dry van versus for specialized. So for refrigerated, bulk, and flatbed. And what we're seeing is that the red series, which is for dry van, we saw those contract prices shoot up very rapidly in 2020, which is very consistent with what Dean was talking about, of the strong demand for consumer products. But those prices for those contract rates seem to have essentially leveled out as of May. But instead, what we're seeing then is for specialized freight, those contract prices are still going up. Those have been much more delayed, but we're seeing those continue to go up. And so my guess is over the coming months, we've got more running room to see contract price increases in the specialized market, which is, again, more of an industrial focus, especially on the flatbed side as well as the bulk side. So you combine together the fact that our overall volume is better than it was last year, fairly comparable to where we were in 2019 on the trucking side, but you have record prices. What you end up getting is revenue at record levels for this time of year. So there's really three different indices for trucking revenue. There's U.S. Banks Index, which I've shown here in gray in the left figure. The Census Bureau, through the Quarterly Services Survey, surveys a stratified random sample of carriers to calculate industry revenue. And then my colleague Yem and I also publish an index. What I've done here, and this is just for comparative purposes, is show what how these indices are behaving back through 2016. What you can see in the left figure is the fact that U.S. Banks Index appears to be weighted a little bit more heavily towards the small carriers, and my guess is especially independent owner operators. And that's why you see these very pronounced spikes in revenue in the fall of 2017, which was the beginning of the prior bull market, as well as this very pronounced spike in 2020 in Q3 and Q4, as well as then Q2 of 2021, which is all corresponding to record high spot price jumps at the time. In comparison, the census index, as well as the index Yem and I publish, which you can see to the right, have been a little bit more muted than U.S. banks over that time period, and they correspond very, very, very well. And these are two completely different methodologies I need to add to calculate these. We've seen a tremendous spike upwards in Q2. So we've actually seen overall revenue hit record high levels. And typically, at least with the census data, Q3 tends to be the highest period. So it'll be interesting to see as we move forward just how high those revenue figures get, given that nobody sees contract or spot prices going anywhere at the moment. Which, though, then that poses the question that ultimately is going to affect the market, is where are we going to be heading for employment? And one thing I want to stress as we take a look at the employment figures, because you likely see these stressed every month in FreightWaves and Journal of Commerce and other industry sources. Oftentimes what gets the most attention is what I call the headline number. So overall truck transportation employment. One thing I want to stress with that is that number is not that informative right now for all of us. And the reason for that is because we've had a substantial shift relative to, let's say, going back to 2018, to the sectors in which drivers are employed. So if you take a look, what I've done in this chart is I've compared June of 2021 through June of 2018. If you look at overall truck transportation employment, we're just 500 employees different according to the BLS. 5,000 different, I apologize. 500, I'm getting my numbers confused here. But that almost perfect equality hides a massive shift of over 20,000 more drivers in general freight local. So those would be drivers delivering, say, large, bulky e-commerce shipments. So we've had 20,000 additional drivers in that sector. And how do you get that? Well, the only way to balance those statistics out is we know that the long haul employment has to be down. And we see that employment's down over 8,000, almost 9,000 in general freight truckload. It's down substantially, almost 4,000 in less than truckload. It's down somewhat in specialized. And so as we think about, what does this mean for, how the market's going to behave, is the key issue is, are we going to start to see that increase in growth of the employment in the long haul sectors? June's data finally showed an uptick, but brutal honesty, we've hardly seen general freight long distance truckload employment has barely budged since the end of, the worst month of employment, which was April of 2020. So that's the key thing we're looking at now, is how rapidly do we start to see employment go up? And so with that, I am said my piece, so I will hand it back.
That's kind of fascinating stuff. We've been saying for about a year now, Jason, that with the shift in warehouses being built closer to populations, the shift to more online versus bricks and mortar, I've just seen, this is anecdotally in a small sample, but I've seen a significant shift in how how the workforce has sort of located itself. And to give you an example, the traditional long hire student model, you sort of, to get your CDL and get into the industry, you'll go and work for a large student training fleet who'll put you through a 3-week class. You'll run with a mentor for a month, guaranteed minimum salary of $500 a week, and then after about a month, you're on your own with your first solo dispatch, and you probably have to stay there for about a year or so to pay off your loan to get your CDL. So there's a couple of things that have to happen there to get at least a year's experience. But the underlying all of that is the desire for people to work and live and be at home. And of course, in long haul trucking, that's not the case. You're out, you're home maybe a day for every 7 days out. So with the increase in jobs closer to home, I think that traditional hiring model, or that traditional cycle of drivers into long haul and then through a succession of jobs working back closer to home over time, that could take 5 or 6 years. I mean, it's not a quick thing. I think that model's been broken, and that's why I said last year that I think capacity will remain tight in truckload because of the substantial increase in jobs where you can earn a comparable salary to over-the-road trucking, but be home or certainly closer to home during the work week. So you've got a better home-life balance. So I think you've just sort of, I think answered that question. I don't know how that changes. I think there's been such a structural change in how truckload finds its drivers in the last probably the last 12 months. COVID has certainly accelerated the departure of a lot of, baby boom generation out of the industry, more so in Q3 of last year than any other quarter, I think. So we've got a decreasing labour pool that I don't know how we address that.
No, I would agree with that. I mean, I think that, and you mentioned it, that it's the competition from jobs from other sectors. I mean, right. Parcel employment is still up tremendously from 2018, 2019. Right. Warehouse employment is up tremendously. Right. And so I think as we think about driver recruitment, that's going to be the challenge. I think the other thing that we're going to see, and this is sort of a big macro level picture, and it's a discussion some of us are having as researchers, but as the freight economy continues to transition with the trade sector being a bigger driver of activity, that would suggest you're going to have your drivers domiciled more in urban areas relative to, let's say, rural areas, because these shorter distance shipments now matter a lot more.
Right.
And so we start even thinking about, if you look at where trucking companies were located, we can get the data back to the 1990s. Does that look different today than it did in the 90s? And how does that look then moving forward a few years in the future, given the ongoing trends? Because things like this are going to affect how do I go about recruiting my workforce.
Right. I think you're going to find a lot of people are going to have to move closer to populations in terms of where the work start, occurs, which means dedicated becomes a much more attractive model to a lot of carriers. I remember some truckload carriers telling me repeatedly over the years that we hire our own problems. And by that, they mean that we hire drivers from areas that are a long way away from home. They've got a long commute, but the different work style of different generations is significant. It's been evident for the last decade where, different generations have a lower likelihood of driving a longer distances to work. So the extrapolation of that is if you don't want to drive long distances to work, why would you drive a truck long distances? So you can see how through the challenges that we've got with different work styles and different work preferences, that truckload, long distance one-way networks are going to become problematic for a lot of companies, because that flow of drivers is just not going to be there because of the desire to be home more often, and that's why they'll have a lot more competition. Jason, this has been a fascinating discussion. We won't be able to get to all of our questions that we've got queued up here. But for everyone listening, you can write to us at datiq.com or askiq@dat.com. Sorry, askiq@dat.com. We can get to your questions there. Jason, any sort of closing comments as we wrap up the show? Any sort of crystal ball projections as to what the rest of this year is going to look like? We've got, I noticed on Saturday from Kip Loughton at the Marine Exchange that we hit 40 vessels at anchor on Saturday, which was now back to the February record. So it looks like peak season is here. And I guess the question that I get asked the most is, when will peak shipping season hit, or is it already here? Thoughts?
Yeah, so I mean, on the retail side, we still have demand very much elevated from where we were in 2019. We're up about, I think, for retail trade, excluding motor vehicles and parts, because that's kind of its own little thing, we're still up well over 10%, which is very, very, very pronounced. Typically, the rough estimate was a compounded annual growth rate pre-COVID of about 3.3%. So essentially what's happened is we've had about 3 to 4 years of growth in 1 year, which is incredible. So things are going to be, this year is going to be rough. If you look at where retail inventories are at relative to sales, we're still at very, very, very low levels. So that's one of the big reasons for all the imports. And especially now with the change in consumer behavior, people are buying clothing like they never have at this time of year. And the vast, vast, vast majority of clothing has to be imported. Furniture, electronic products, still most of these items are going to be imported.
Got it.
The one thing I can say that we've seen from some of the data that was just published by the Census Bureaus, we are starting to see a change, though, in consumer buying behavior as it pertains to e-commerce. And that behavior is that for retailers who primarily are brick and mortar, in Q2 of 2021, we actually saw a decrease in e-commerce sales relative to Q2 2020. And this is kind of an across the board, whether it's food and beverage, or it's building materials, or it's furniture, or it's electronic products, or it's general merchandise. We saw a decline. For pure play e-commerce retailers, that spending still went up, though. And so what it's suggesting to me is that as we're moving forward, previous to COVID, we were seeing e-commerce grow at 14% a year. And over half of that growth was accounted for by essentially pure play e-commerce retailers. Once COVID hit, that number jumped to 38%. So we went from 14% growth in e-commerce sales year over year to 38% on average for Q2 2020 through Q1 2021. So for an entire year, 38% growth. But most of that growth actually came from e-commerce sales of brick and mortar retailers. So we saw a switch. Well, now what we're seeing is, it appears, a snapback to where consumers who are using brick and mortar retailers are heading out to the stores more and using those e-commerce channels less. And so what I think we're going to start seeing is that a stall out of e-commerce sales for the brick and mortar retailers. The caveat of this being Q2 of 2021 is not capturing the Delta surge. So the Q3 data could behave a little differently. So we may see another bump back up, but it does tell me once we get COVID under control, is that for the brick and mortar retailers, I think e-commerce sales they're not going to keep heading up from where they were in the worst of COVID lockdowns. That's what's becoming apparent.
Right. Fascinating. We're out of time, Jason. We're going to have to wrap up there. Thank you for being on the show. And for those that don't follow Jason, make sure you're connected with him on LinkedIn. He posts every single day with some really good content. We'll have a market update out next week with some of the material Jason's covered today, in that with some of the charts that we didn't get to post today. So just to wrap up the show, a couple of announcements. Out of an abundance of caution, DAT's leadership has decided to cancel our DATCon 21 conference in Austin, October 4 to 6. Difficult decision made out of concern for the health and wellness of all of our employees, customers and partners due to the recent uptick of COVID-19 infections in Texas nationwide. we're disappointed we can't connect with a lot of you in person. We were looking forward to doing that in October, and we can't emphasize enough how much we appreciate all of your ongoing support. Again, if you have questions, shoot us an email at askiq@dat.com. That email hits our inboxes and we get those pretty quickly. Remember our weekly updates at dat.com/market update. Don't forget to check out Chris Kaplas's Freight Find podcast. Great issue out last week. He interviewed Matthew Ellenjickle, CEO from Four Kites, talking supply chain visibility. And I'll be on Rates and Lanes podcast tonight at 7 p.m. with Chuck Snow and Rico Muhammad. Also on Landline Now tomorrow night at 7 p.m. Eastern, and Radio Nemo at 8 a.m. Thursday. And, of course, on the Mark Willis Show at 3 p.m. this coming Friday on Sirius XM Road Dog 146. That's about all we've got for this week. We'll see you again next Tuesday. I hope you all have a great rest of your week. Thanks for watching.